Welcome, everyone, to our seminar, Liability Management, the Tax Angle. I'm Tom Humphreys, a tax lawyer with Mayer Brown in New York. With me today are my colleagues, Remote Reigersman and Brennan Young. Now, before we get going, I've got to read some intro material. So, the couple of different items I need to go through. First of all, to ask questions, please use the Q&A widget on your screen. We will try to address questions throughout the webinar. Otherwise, we will get back to you via email. For those seeking CLE credit today, please download the affirmation form and the evaluation form found in your resources widget on the screen. We will announce the CLE code once during the middle of the presentation and again at the end. Please return both forms for CLE credit. The presentation and supplemental materials are available for download from your resources widget. We will also distribute these via email after the webinar. Okay, so the housekeeping is out of the way. And I want to welcome everyone again, and I hope everyone is well. We all know that the stress businesses are under as a result of the coronavirus pandemic. You know, we can see it every day in the newspapers: missed interest payments, debt restructurings, even bankruptcies. And our experience, and I'm sure yours as well, when things like this happen, unfortunately, a company's thoughts turn to its outstanding liabilities. Now, in early April, we presented a liability management seminar with our corporate colleagues here at Mayer Brown. And after that, and given what is happening in the debt markets, we thought it might be helpful to spend an entire session on the tax side of liability management. And if I didn't mention it already, I, Tom, Remel, and Brennan are all tax lawyers with Mayer Brown. Now, in our experience, the tax consequences of various liability management transactions can be quite significant for both the borrower and the lender. As usual, there will be tax consequences when a borrower buys back its debt, renegotiates its debt, or exchanges its equity for its debt. Now, if you know about them on the front end, you can usually manage those tax consequences. However, if you ignore them or don't realize they're there, then they can come back and bite you. We've experienced that a number of times throughout our careers. So we thought now would be a good time to flag various tax issues for those currently contemplating LM transactions. So let's take a look at our next slide, and that's our agenda for today. So the first thing we're going to talk about is debt repurchases. That's relatively simple. But in a liability management situation, it sort of serves as a baseline for the tax consequences of LM transactions. Then we're going to talk about debt modifications or debt for debt exchanges. A little more complicated, but we see those just literally all the time. Debt equity exchanges, so an issuer issues equity for its outstanding debt. And then bankruptcy restructurings, which in many cases combine elements of modifications, debt equity exchanges, and other transactions. So that's the agenda. I'm going to cover debt repurchases. So again, this is pretty basic, but I want to make sure that everybody's on the same page in terms of liability management transactions. So the first is a very easy one: repurchase at a discount. The company looks out at the debt market, sees that its debt is trading at a discount, and is motivated to buy it back. Obviously requires cash, and if you do buy back your debt, the accountants tell me that you can book earnings immediately in the amount of the discount. I'm not an accountant. I think that's true, but check with your accountant to make absolutely sure. Now, of course, this requires having cash. We know right now cash is king among businesses. So we'll see these transactions. They may not be as prevalent, though, as debt exchanges, for example. So if an issuer buys back its debt at a discount, we have what we call, for tax purposes, cancellation of indebtedness income, and that's simply equal to the amount of the discount that occurs in the purchase. The technical term, tax term, is adjusted issue price, and in most cases, that's going to be the face amount of the instrument. Not all, by any means. So that's pretty easy. You go out and buy back your debt, and you're going to have taxable income. On the holder side, capital gain. Now, that's always going to be subject to something called the market discount rules. And what those will do, potentially, depending on the holder's basis, is recharacterize a portion of the gain as ordinary income. You could have capital loss. If you're a holder, you bought on day one, and now you're selling back at a discount, then you could have a capital loss, assuming that debt in your hands is a capital asset. So that's about what you would expect out of a debt repurchase at a discount for cash. At a premium, if the issuer buys back an instrument at a premium, and here we're adding this for sake of completeness. We know that in many cases issuers won't be doing this right now, but they can. The repurchase premium is deductible by the issuer. It's just treated as interest expense for federal income tax purposes. The only caveat there is a weird code section 249. So that's the Internal Revenue Code. And if you buy back a convertible bond that you issued, or your subsidiary issued, or your parent issued, then you can only deduct as interest something called a reasonable repurchase premium. And the idea here is that it would be the repurchase premium if it had been straight debt, not convertible debt. And the further idea is that you cannot get a deduction for buying back your equity. The holder, the flip side of this, they're going to have a capital gain, again, subject to the market discount rules. Something that you probably would pick up on, but not necessarily so. If you have a related party debt purchase, then the debtor can still recognize a cancellation of indebtedness income. So, for example, that would be where a subsidiary of the debtor buys back the debt. It also applies where there's an indirect purchase, and then the purchaser becomes related. And the reason for that particular provision, and this is Code Section 108 of the Internal Revenue Code, the reason for that particular provision was a transaction called Bondco, B-O-N-D-C-O, Bondco. It was a series of transactions, actually. And by today's standards, it was incredibly simple. But the way it worked was that an investment bank would set up a corporation. The investment bank would go out and buy up a company's debt. And then it would sell the stock in the corporation to the company. And the notion was, at the time, Code Section 108 only applied to repurchases by the debtor. And since the repurchase had occurred at a time when the purchasing corporation was unrelated to the debtor, it was thought, and I think it proved out on audit, as I recall, pretty well. It was thought that that was not a purchase by the debtor or even a related party. It was a purchase by an unrelated party who, guess what, became related pretty quickly. So there are now, Code Section 108 has been expanded, and this is really in the regulations, to even include a situation where the purchaser becomes related. There's an exception to that for debt retired within a year, to be retired within a year. And you also can end up with a situation where there's a deemed reissuance or a deemed issuance to the related holder, and that can create some OID consequences. So first slide, straight debt repurchases, cash, pretty basic. Second slide, repurchases by a related party, including somebody who becomes related. Now, the next thing I want to talk about are repurchases of something called contingent payment debt instruments. Now, we'll talk about how rare or not rare these are in a second, but before we do that, what I want to do is just give you an idea of how these are treated. So contingent payment debt instruments are debt instruments, as the name suggests, where there's a contingency. And what the Internal Revenue Code does, or the regulations, because we don't know how the contingency is going to turn out, the issuer is allowed to deduct interest on that debt at something called its comparable yields. And that's the interest rate, the yield at which it would normally borrow money. So the issuer will have phantom deductions, their original issue discount deductions, to the extent you have a contingent payment debt and you are able to deduct the interest at the comparable yield. The holder has to include that in income at the same time, so there's mirror image treatment. So these, you may or may not see these. We see these a lot with financial institutions who issue contingent payment debt. But one thing I want to flag, there's an old class of instruments called contingent convertible debt, where this issue comes up in spades. And by this issue, I mean the repurchase issue. So with contingent convertible debt, it was a debt instrument convertible into stock of the issuer, but it also had some sort of contingency. And under the magic of the Internal Revenue Code, as I said, that contingency then allowed the issuer to deduct OID deductions on the instrument at its comparable yield. And these transactions were prevalent in the early to mid 2000s, and I think the first transaction was done in 2001. So the issue that it raises is that when an issuer buys back its contingent payment debt instrument, you get something called a positive adjustment. And the idea here would be there's a true-up. So if you were deducting interest at your comparable yield, and then it turns out that you will never have to pay that interest economically, then you have to recapture that deduction. And for the holder, it's the flip side. They have a loss. So the reason I mention this is that even though this class of instruments was done, as I said, early 2000s to mid 2000s, maybe even later, they still sort of lurk on corporate balance sheets. And one of the reasons they lurk on corporate balance sheets is that they are providing interest deductions at a nice high yield without any cash interest payments. So if you have one of these things on your balance sheet, be very aware that if you buy back the instrument, you may have a giant amount of taxable income. How giant? Well, we just ran some numbers this morning. And so let's say you did 100 million of this in 2001. At an 8% comparable yield, the adjusted issue price, the accreted amount, would be almost $500 million. And so the situation to watch out for is when your stock has fallen. Sound familiar? If your stock has fallen and you end up either retiring the instrument or buying it back for the original 100 million. So you issued it for 100 million, you now buy it back for 100 million or less. And you think, well, nothing happens to me. Well, that would be wrong, because in my example, where it accreted up, the issue price accreted up because of the contingent payment deductions to 500 million, you would have $400 million worth of taxable income. Not a happy thing to discover if you've already bought back that instrument. And if I look out, I did a little internet search, and it turns out that the original company that did one of these, a company called Danaher, which I think is in the tire business, they actually have some of those contingent lines on their balance sheet. 30, 40 million, I think a lot of them have been converted. I don't know where their stock price is relative to the conversion rate, but they were 20-year instruments. And I looked at some others, and 30-year instruments. So they can still be out there. And I've seen clients that like having them out there because as I said, there's an interest deduction. So a trap for the unwary doesn't apply to everybody. but check your balance sheet and see what you got on there. That might be a contingent payment debt instrument. Okay, with that, I am going to turn it over to Brennan, who's going to tell you about debt modifications or exchanges.
Thanks, Tom. So Tom kind of started with what I would consider to be the base case, which is where the issuer repurchases their debt with cash. But how about where the issuer modifies its existing debt or exchanges outstanding debt for a new debt instrument? Well, it gets kind of complicated. It's kind of like an onion. There's a lot of layers to arriving at a conclusion on this point as to what actually happens. So we thought it'd be useful to start with an overview. And to start with, the U.S. tax consequences here generally center on whether there's been a significant modification, quote unquote, within the meaning of the relevant Treasury regulations. And if there has been a significant modification, then the consequences to the parties from there depend on whether the debt instrument is, quote unquote, publicly traded. So we'll touch on those two things, and then we'll provide you with an overview of what happens to the parties when there is a significant modification, so both the issuer and the holder. And then finally, we'll touch on some consequences of including consent fees for certain amendments. And one thing to keep in mind as we kind of jump into the significant modification disclosure or discussion is that the question applies equally in situations where you're amending terms to an existing debt instrument and when you're doing a debt-for-debt exchange. So the rules and the regulations even say these rules apply in both cases equally. So unless an amendment to a debt instrument results in a significant modification, there are generally no tax consequences to parties. So it becomes important whether there is a significant modification or not. And the question, it's almost self-explanatory in the name, but there's two components. First, whether there has been a modification, and then second, whether that modification is, quote unquote, significant. So what is a modification? The definition starts out broad and generally says a modification is any change or alteration to a debt instrument that changes an obligation of an issuer or a holder. So that sounds like almost anything. There are a few key exceptions, though, that kind of pare down that generally broad rule. So there's three. We'll go through them. First, there's no modification if the modification occurs pursuant to the terms of the debt instrument. So an easy example to think of is like a fixed to floating rate instrument where the interest rate switches from fixed to floating at a certain point in the instrument's term. That's clearly pursuant to the terms, and that's not a modification, and therefore not a significant modification. A second exception is where there is a unilateral option of one of the parties. So if we're talking about a unilateral option of the issuer, that fits the exception as long as it meets some prongs I'm about to go through. But then if it's a unilateral option of a holder, there's an additional layer to meet the exception, and that is that the exercise of the option cannot result in a deferral or reduction of an interest or principal payment. So when is an option unilateral? There's, again, a few prongs here, but the big one is that no party can have a consent right over the change in order for it to be treated as unilateral. Some of the others are the other party can't have a put right. There can't be a requirement for more than a de minimis amount of consideration to be paid. And then the party cannot have a right to change the terms when there is a change. And then, so that's two of the three exceptions to what is a modification. And then the final one is for forbearance, which is a word that's been coming up a lot these days. But a forbearance exception generally says if a holder, so a lender, waives a right to acceleration or a similar default right for up to 2 years for a issuer's failure to perform, that's not a modification. Although that sounds like it would be really helpful, it has limited usefulness because the regulations provide that any agreement, which can be either written or oral, actually alter the terms brings us back then into being a modification and outside this exception. So, for example, if they don't exercise rights when there's been a forbearance in payments, that meets the exception. But then if they say, okay, if the issuer says, or sorry, if the lender says, why don't you go ahead and pay us at the end of the term the extra interest that we're letting you skip, then that is an agreement to amend the instrument, and you're then outside of the exception. So that's kind of a long way of clearing my throat to covering what is actually on this slide. So that covers what is a modification. So once we have one of those, if you don't meet one of those exceptions, the question is your modification significant? And the regulations are set up to start with a broad facts and circumstances test. You see that there on the first dash, which is generally, the regulations ask whether the legal rights and obligations of parties are altered in a way that is economically significant based on all the facts and circumstances. It sounds pretty broad, not a ton of guidance on exactly what that means. But fortunately, the regulations then provide 5 specific tests for 5 different situations, I'll call it, or types of changes that we'll go through. So first is the change of yield test, they call it, or we call it in the tax world. That's where there's the yield of the instrument changes, and by change we mean either an increase or a decrease in the yield by more than the greater of 25 basis points or 5% of the annual yield on unmodified instrument. So that's when you're adjusting the interest rate, for example, or making additional payments. The second test is for the material deferral of payments on the instrument. So this is where we're back to deferring payments on the instrument. Here, there's a safe harbor for when a deferral of payments will not be treated as material, and that is where one or more scheduled payments are deferred by more than the lesser of 5 years or 50% of the original term. So, for example, if you had a 8-year instrument, you could do a 4-year deferral. Note that this rule applies both to deferring actual payments and then also refers to extending the term of the instrument itself. And the third type of test for what is significant is whether there's changes in the obligor or security for the instrument or other types of enhancements. So think of adding a guarantor, for example. Then the fourth is a change in the nature of the instrument. So, for example, if the instrument shifts from being debt for tax purposes to being equity for tax purposes, or from recourse to non-recourse. And note that in one helpful point here is that in making the determination of whether the new modified instrument is debt for tax purposes, any decline in the credit quality of the issuer is generally ignored. So you would look to the credit quality at the time of the issuance of the original instrument. And then finally, this is more of an exception to what is not a significant modification as opposed to the others, which give you some parameters. But a modification that adds, deletes, or alters a customary accounting or financial covenant is not treated under the regulations as a significant modification. Now, what appears on the slide there is all the more language that there is in the reg. So there's not a lot of expansion on what would be considered customary. But as we note on the slides, this comes up in the context of consent solicitations, for example, that pare back on some like customary accounting and financial covenants. That's where you might potentially be able to use this this exception. So now we're moving on to the consequences to the parties. You have fresh in your mind what kind of change can result in a significant modification. And let's just assume now that there has been one. So what happens next? In the case of a debt for debt exchange, then you're treated as exchanging the two instruments. And in the case of an amendment of terms that results in a significant modification, there's a deemed exchange, which is treated as the old debt instrument exchanged for a new debt instrument. And that is deemed to be the case under the regulations. And then finally, when you have this happen, the question becomes, what is the issue price of the new instrument for determining whether there's been gain or loss on the deemed exchange or the actual exchange in the case of the debt for debt exchange? And the answer then depends on whether or not the old instrument or the new instrument is treated as publicly traded, which we have another slide on that we'll get to in a second. But if the instrument is not publicly traded, then the issue price of the new instrument is generally the principal amount. And if it is publicly traded, then the issue price of the new instrument is its fair market value. So this is where, if it is publicly traded, that's where you could have some of these negative tax consequences that we'll get to in a second. So I obviously have used the words publicly traded a bunch, and that it becomes important to this analysis. So when is an instrument treated as publicly traded? I'll cover the specifics in a second, but the upshot to keep in your mind is that it is relatively easy to trigger publicly traded status for the reasons I'll describe in the context of what definitions are actually in the regulations. But there is an important exception for smaller issuances. So if the principal amount of the class is 100 million or less at the time you're determining whether the instrument is publicly traded, that falls within an exception. So as I said, a debt instrument is treated as publicly traded if any time within 15 days before or after the issue date, there is available for the instrument a sales price, a firm quote, or an indicative quote. So what are these? It starts with something specific, and then it goes pretty broad. So a sales price is a price for which an instrument is actually sold that's reasonably available after the time of the sale. A firm quote is a quote for a sales price which is representative of the price at which the instrument would actually be sold. So you can see getting a little broader there. And then the final category is an indicative quote, which is a quote from one broker dealer or a pricing service that is not necessarily substantially the same as the price at which the person receiving the quoted price could purchase or sell the instrument. So this is where it's really broad, because it doesn't even have to be the price that the instrument could actually be sold. It just has to be a price that someone gave to the instrument. So as you can see, it's pretty broad. And then one thing we just want to note here is that there are anti-abuse rules that go both ways. So there's a 30-day period, as I described, 15 days before and after the determination. So any temporary restriction on the trading, a purpose of which is to avoid the public trading rule, will cause the instrument to be publicly traded de facto. And that's true regardless of whether the restriction on trading came from the issuer. And then on the other side of the coin, if the principal purpose of a sales quote or any kind of quote is to cause public traded status, that price or quote is disregarded. And then finally, just as a procedural matter, we want to point out that it's the issuer's obligation to determine whether an instrument is publicly traded and make information available to the holders within 90 days of the issue date of the instrument in a commercially reasonable fashion, which can include electronic publication. And generally speaking, the issuer has to put that information out, and the issuer's determination is binding on the holders. So now we'll take a short break from the proceedings to read the CLE code. You should see it on your slide there, but it's 05 MB as in Mayor Brown, 06 LM as in liability management. So one more time, 05 MB 06 LM. Please include this code on your affirmation form, and both the affirmation form and the evaluation form are found in your resources widget on the screen. So with all that in mind, Remelt, can you maybe walk us through the tax consequences to the issuer when there is a significant modification?
All right, thanks, Brandon. Yep, I'll cover the issuer side. And so a couple of things to note. So one, and this is relevant for, I guess, both a distressed scenario where the issuer is in distress, where maybe debt is trading at a discount, as well as what I'll call, I guess, regular situations, non-distressed situations. And so there's relevant consequences to an issuer in each position. For purposes of debt-for-debt exchanges or modifications where it's more of a distress situation, there is the potential of cancellation of debt income, COD income. Obviously, that is an unhelpful situation to be in, because typically the cash that was raised through the issuance of debt has been spent in whole or in part. And so having a restructuring that results in a modification for tax purposes that triggers COD income is not helpful, because that'll result in a tax liability. There are exceptions. There's a number of exceptions. One exception is for taxpayers, issuers that are in bankruptcy, so a Title 11 type of proceeding. There's another exception for taxpayers that are insolvent. There's a few other exceptions that kind of go outside the scope of this presentation. Insolvency can get tricky in terms of how to determine insolvency and the extent of insolvency, since the exclusion is for the extent of insolvency. And it gets especially tricky when you deal with, let's say contingent liabilities, or it's not entirely clear how to determine liabilities and whether they are liabilities or not, to figure out the extent of the insolvency. And the other issue to keep in mind for both of these exceptions is in the context of flow-through entities, so whether they are partnerships for tax purposes or maybe disregarded entities for tax purposes. Since these tests are generally applied at the partner or owner level, so if you've got a partnership restructuring debt that triggers COD income, and you're looking at one of these exceptions, it's the partner that has to be in bankruptcy, not the partnership. And so, and same with the insolvency piece. So, obviously, bankruptcies of a flow-through entity would be something that has an impact on the owners. And so, kind of in the public markets, one category that immediately jumps out are, for example, master limited partnerships, MLPs. A lot of them are in the energy space. Obviously, the energy space is suffering somewhat, considering the prices in the market. And so, if you see an MLP restructures debt, or an MLP files, let's say, for bankruptcy and then restructures his debt, that's a potential tax trap, because any type of COD income that gets triggered is going to hit the partners, the unit holders of the MLP, who might not be able to avail themselves of an exception that is otherwise available to let's say, a corporate taxpayer. So that's one set of issues on the distress side. The other issue is OID. So often, if there's a debt modification, the new instrument can have OID, or original issue discount. There's various issues that spring from that on the holder side, on the issuer side. OID can result from actual discount, right? So having something with an issue price that is below the principal amount, that can result in OID. You can also have OID by virtue of an instrument that pays interest through a PIK feature, so it pays in kind rather than in cash. That can result in OID, and we'll take a look at the next couple of slides at a specific set of OID issues concerning AHIDOs. But before we jump into that, on the last bullet of this slide, on repurchase premiums, Tom mentioned this at the beginning when he talked about the repurchase of debt for cash. But that repurchase premium can also apply to debt modifications or debt exchanges. And so that is obviously, now we're talking about a premium, so debt's got to be trading at a premium. So this is obviously less likely in a distress scenario. But my understanding is there are a number of debt instruments that are trading at a premium, even the current environment, because of the low interest rate environment we're in. So So debt instruments with higher coupons and where issuers are deemed creditworthy, instruments might be trading at a premium. And so there is a tax, I don't know, say arbitrage possibility here, where if you do a debt for debt exchange, where the old debt, the original debt's trading at a premium, you're able to deduct that premium up front, and over time that is given back then through future amortizations. But the net present value of that deduction can be meaningful. And so premium repurchases have been used by issuers to take advantage of that net present value calculation. It was especially powerful in 2017 when the corporate tax rates were still 35%, right before they went down to 21% under the Trump tax reform. Because in that, had you done a repurchase premium transaction back then, you got a deduction of 35, and then income inclusions at 21% over time. So the NPV there was kind of turbocharged. So it's a little bit less turbocharged now, but there's a benefit there, and I know that there's a number of market players that are exploring using this. All right, so let's take a look at. Let's take a look at the AHIDO provisions on slide 14. So. AHIDO stands for Applicable High Yield Debt Obligation. And so if you have an AHIDO, then the issue is that a portion of the discount is treated as not deductible, as a non-deductible dividend, and the remaining piece is not deductible until paid. So I guess the general rule would be for OID is OID is deductible to an issuer as it accrues. It's includable by the holder as it accrues. But if something is in a AHIDO, then special rules apply. So when is something in a AHIDO? You see there code section 163I. An AHIDO is an instrument that has a maturity date of more than 5 years. The yield on the instrument has to equal or exceed the AFR, the applicable federal rate, plus 5%, 500 basis points, and the instrument has to have significant OID. And significant OID exists if at the end of an accrual period that ends more than 5 years after the issue date, the aggregate amount of the accrued but unpaid OID exceeds the issue price times the yield to maturity, which it's, in my mind, a bit of a complicated definition. I mean, there's a lot of definitions in the AHIDO space that are complicated, but essentially the significant OID prong asks, if the debt allows the issuer to pay more than 1 year's worth of interest over the course of the first 5 years in kind through OID. And so that kind of determines then whether there's significant OID or not. The disqualified is not on the slide, but the disqualified portion is really the excess of, and I'm simplifying somewhat, but it's the excess of the AFR plus 6% disqualified portion. So that's not deductible at all. But if there's a corporate holder of the AHIDO instrument, it's treated as a dividend, and therefore the holder might get a dividends received deduction. So there's a little benefit there. It's essentially treated like it's a return on stock. And then the remaining piece, the piece that's not a disqualified portion, and is the deduction to the issuer is deferred until it's actually paid on the instrument. So let's do a quick little example just to illustrate this. So let's say you got a note with a principal amount of 1,000. It's issued at 800, so the issue price is 800. So there's a $200 discount there. It's got an 8-year term, pays 10% every 6 months as a coupon, and so the yield to maturity, if you plug it into Excel, is about 14%. So the question is, well, is that an AHIDO? Answer is yes, because it has a term of more than 5 years. The yield to maturity, 14%, exceeds the AFR, which is really low at the moment, around 1%. The AFR plus 5, that's a little over 6%. And then, does it have significant OID? And the answer is yes. And we won't go into the details of exactly how we calculated that, but essentially, the amount of OID that was deferred during the first 5 years exceeds 1 year's worth of interest on the instrument. And so, as you can see, a HIDO is not favorable. You'll often see a HIDO catch-up provisions in debt instruments, which essentially means that after the first accrual period after the 5th anniversary, there is a catch-up payment. So the issuer has to pay a certain amount of cash to avoid there being significant OID, to avoid the HIDO rules altogether. And obviously, if you structure something that is, does not exceed 5 years, which we see quite a bit too, then we can also avoid the HIDO rules. All right. With that, I turn it back to Brennan for the further discussion on the holder side. Brennan?
Oh, sorry. Technical difficulty there. Thanks, Ronald. So for the consequences of the holders, we're going to start with a situation where the issuer is a corporation, because if that is true, then the first step for determining the consequences to the holders is asking whether the restructuring that resulted in a significant modification constitutes a recapitalization under Section 368A1E of the Code. These are from the same part of the code for reorganizations that are tax-free, but it also can apply to exchanges of debt for debt. And the key factor in determining whether a exchange is a recapitalization is whether each instrument is a security as defined in the code. And whether or not something is security, generally there are other factors, but it generally depends on the term of the security and or the term of the instrument, sorry. But for determining whether an instrument is security and figuring out the term, we're talking about the term of the remaining on the instrument. So for example, if you do an amendment that results in a significant modification on what is a 10-year instrument, you make this amendment in year 4, then the term on the new instrument that you're deemed to have to exchange for is 6 years. So I just want to point out that you don't get the full 10 years. In both cases, it's cut short when you do the deemed exchange. So how long of a term is good enough to be treated as a security? Under applicable guidance, a term longer than 10 years is generally treated as a security. Shorter than 5 years, generally not. And then if you're in between those two, you're kind of in a gray area where the answer is not entirely clear, at least based on current guidance. So let's say that you have a recapitalization. What does that mean for the holders? Well, generally, there's no gain or loss on the deemed exchange in the case of an amendment, or in the case of a debt-for-debt exchange on the actual exchange. But there still could be other tax consequences. For example, if the issuer pays cash or other property in connection with the modification, so it's not just changing a term or just exchanging debt for debt, but you get something else, like a little bit of an extra incentive fee or something like that, that could be considered boot, which could be taxable to a holder upon receipt. So it would be generally non-recognition, but plus a little bit of recognition to the extent of those amounts. And in addition, the OID concerns that Rimmel just went over are present even where there is a recapitalization. So if the holder has a higher basis than the issue price of a new note, there could be amortizable bond premium. And then, as Rimmel went over, if the issue price is lower than the principal amount, then there could be OID. So how about where there is a significant modification and there is not a recapitalization with respect to the holder? for example, because the issuer is not a corporation or because the remaining term of security or the instrument is too short. Well, in that case, the holder can generally recognize gain or loss equal to the difference between the holder's adjusted tax basis and the issue price of the new instrument, again, hinging on the issue price hinging on whether or not the instrument is publicly traded. And what is this capital gain? What is the character of it? It's generally capital gain or loss, except to the extent of accrued market discount, which would be ordinary. And then one final holder-specific point that is specific, further specific to non-U.S. holders that I'm not going to harp on for too long because it could kind of be covered by its own separate presentation, but that is whether or not a non-U.S. investor could be treated as deemed to be engaged in a U.S. trade or business on account of modifications. Some non-U.S. investors that invest in debt instruments in the U.S. Avoid trying to be treated as engaged in a trade or business in the U.S. for U.S. tax purposes. They do that in part through a safe harbor for non-dealers that are merely trading in stocks and securities for their own account. It's called the Securities Trading Safe Harbor. However, if a non-U.S. investor is engaging in too many workouts with too much frequency, or, for example, purchasing loans with an intent to work those loans out, it may start to look like the issuer is treated as engaged in a trade or business of working out loans. So that's just something to be aware of, and it's a complicated question, so we'll leave it at that for now. And with that, Rummel, do you want to talk to us about the payment of consent fees in the connection with modifications?
Yeah, so on consent fees, so you often see a consent fee for various things, either for exchanges, for early tenders, for changes to covenants. And so the question is, what's the tax treatment of those fees in the hands of a holder? And maybe to start off with, how are those fees treated in connection with determining whether there is a significant modification? So Brendan has kind of gone through the parameters in determining or making determination of whether something is a significant modification or not, which includes that yield test. And so generally, if there is some kind of consent fee, consent payment paid, or early tender premium, something like that, that is taken into account in determining a change in the yield of the instrument. And so that fee in and of itself might add to tripping something into significant modification land for tax purposes. Depending on what the exact transaction is, what you'll see in public filings is that the fee can be treated as, in part, as a piece of the amount realized, so that it'll essentially give rise to capital gain or loss, but it goes into the capital gain loss calculation. Or it can be treated as a separate fee that gives rise to ordinary income. You kind of see it both ways, but typically that treatment will depend on what the fee is for and how the underlying transaction is structured. On the non-U.S. holder side, the issue then comes up, is there a withholding tax on that fee? We know there's no withholding tax on interest because the portfolio interest exemption should apply. But, what is this fee? Is it interest or is it not interest? There is a private letter ruling that you see there on the slide from 2011. In that ruling, the IRS said, it's to the extent of accrued interest, we're going to treat the fee as accrued interest, as the interest payments of the portion that has accrued. So it more or less answered that piece of the question. It didn't really answer the question of, well, what about the excess, to the extent the fee is bigger than accrued interest, number one. Number two, then, well, what happens then when the interest that was accrued then actually gets paid? What's the character of that? So there's a few gaps in there. I would say overall, if you look at public transactions and public filings, I don't think the market is withholding on fees when they make their way into the hands of a non-U.S. Investor or non-U.S. creditor. Okay, in the last few minutes we have, let's two more topics. Let's briefly talk about debt equity exchanges, and then we'll talk about a couple of topics with liability management transactions inside bankruptcy. So on the debt equity exchanges, what we're seeing a lot of lately are units, investment units. So a lot of companies that are raising capital are doing that in the form of issuing debt or equity, common stock, preferred stock, and with it travels a warrant. A warrant under which additional common or maybe preferred or some equity instrument can be purchased by the investor. And so you just got to watch out for that on the tax side. The question becomes, is it a single instrument? Are they stapled together? Do we treat them as one thing for tax purposes? Or are they two separate instruments? Can they be separated? Do you have common plus a warrant? Do you have debt plus a warrant? And apply the tax rules for each separately. So that's one thing to watch out for and to be aware of. And obviously, the hallmark of the thing that is a single instrument would be convertible debt, right? It's converted. There's an equity derivative embedded in it, but we treat that as one instrument. Typically, when we see unit deals, they are separable, and we treat them as two separate things. On certain occasions, they're kind of stapled more together. So on the debt equity exchanges, if we do a more simple scenario where you've got debt and it's being exchanged for equity, COD income, we talked about that earlier on the issuer side. If it's an actual exchange, you calculate COD income by looking at the fair market value of the equity that's issued and compare that to the debt to determine the extent of COD income. There's a separate rule. You see there the bullet says compare that against the contribution of debt to capital. There's a specific rule in the statute that says if you contribute debt to the capital without getting new stock, then the debt is treated as being satisfied by I think it's the adjusted issue price of the debt in the hands of the creditor. So if the creditor bought it at par, even though it's worth a lot less, if you contribute it to capital, you might avoid COD income altogether. Now, it kind of depends on the shareholder profile and whether somebody wants to contribute and not receive more stock, et cetera. So it's not like it's limitless flexibility, but the takeaway message here is that depending on how you structure something, there can be very different tax consequences. So keep that in mind. On the holder side, the question becomes, is it a recap? Brandon kind of went over when something is a quote-unquote security or not. If it is a recap and there's no gain or loss, then one little important thing to keep in mind is that market discount that was accrued on the debt will carry over to the equity. So when the equity is sold, a part of the gain or all of the gain might be treated as ordinary income under the market discount rules. And then special entity considerations. There might be some holders of your debt or of the issuer's debt who don't want to own equity. REITs come to mind, non-U.S. lenders come to mind. So not everybody might be thrilled. Maybe some people have to sell, or it would be a restructuring where, depending on who the creditors, there can be different consideration packages, for example, to take into account people's different positions. And then a few minutes on bankruptcy restructurings, and I'll note that obviously, bankruptcy restructurings and the tax aspects within bankruptcy restructurings we can in and of itself spend hours on. So this is extremely high level. I think just a few takeaway points. As I noted earlier, cancellation of debt income can be excluded to avoid paying tax on it if the taxpayer is in the bankruptcy proceeding or insolvent. There is a price for it. So to the extent COD is excluded, tax attributes have to be reduced. And you see on the slide which attributes that are and the order in which it happens. So it's NOLs, tax credits, minimum tax credits, capital loss carryovers, and then basis reduction. There is an election pursuant to which somebody can change that ordering. And so depending on kind of the profile and the future business and the type of assets, et cetera, the calculation can be run to figure out what the most beneficial path forward is and whether certain elections do or don't make sense. Section 382 deals with limiting the use of net operating losses if there's an ownership change. A very, very complicated set of rules that deal with ownership changes. You basically have to look at a rolling 3-year period, and you look to certain significant shareholders, and if more than 50% or 50 percentage points in that ownership has changed, the NOL is limited. And so the issue in the bankruptcy context typically is that if you give the creditors equity, there's an ownership change because, let's say all the creditors or the creditors end up with 100% of the equity, there's 100% ownership change. And so to accommodate that, to accommodate a struggling enterprise trying to be successful upon emergence, there are exceptions to that ownership change rule. There's 382L5 and there's 382L6. 382L5 can be a very powerful provision. It essentially allows the corporation to continue using its NOLs as if there's not been an ownership change, but you got to meet certain requirements, which essentially is that former shareholders and old and cold creditors of the company with the NOLs have to end up with at least 50% of the company coming out of bankruptcy. You can't have any ownership changes for the following 2 years, otherwise your NOLs get wiped out, essentially, wiped out from use. And you got to recalculate your NOLs by taking away interest deductions for the creditors for the debt that becomes equitized. So it's almost like you're treating those creditors as if they had been equity holders for those 3 years. And I think it's the prior 3 years and the tax year in which the restructuring occurred. 382L6 essentially. It doesn't make the ownership change go away. There's still an ownership change. It's just that the methodology through which you calculate how many of the NOLs are limited is changed in a way that you don't take into account the debt, and so you can increase the value of the company and you can increase the NOL limitation. And the benefit of that is that it doesn't matter if there's a subsequent ownership change in the future. So under an L5 plan, you will often see restrictions on trading in stock to preserve the NOLs going forward. If the future owners cannot live with those restrictions, then L6 is often a better option than L5. But the message here is really that NOLs can have a lot of value to a bankruptcy estate. There are lots of different ways in which they can be preserved, and it's tricky but possible. And so it's important to bring the tax lawyers into the fold on that to kind of enhance recoveries. So that takes us to the end. I will read the CLE code one more time, which is 05MB06LM. 05MB06LM. We thank you very much for dialing into this presentation. Really appreciate it. And if there's any questions or issues or anything you would like to discuss, feel free to reach out to one of the three of us. Thanks, and have a great day.